Welcome to the General Tax Information for Athletes Part 3, Savings with Register Plans, presented by Pro Bono Students Canada, the University of Calgary Faculty of Law, and the Canadian Sports Centre of Calgary. What is a register plan? It is a government-supported savings vehicle that defers the tax that an individual needs to pay. There are 5 main types of register plans that are available to the general public. The first is a TFSA, or a tax-free savings account. This allows Canadians to earn tax-free investment income to more easily meet lifetime savings needs. The second is a RRSP, or Registered Retirement Savings Plan. This type of savings plan is designed to help you save for your retirement, and the contributions that you make to your RRSP can be used to reduce the income tax that you owe. A registered disability savings plan is available to help parents and others save for the long-term security of someone who is eligible to receive the disability tax credit. A RESP, or Registered Education Savings Plan, is a program where a fund is created for the benefit of a future post-secondary student. Additional money is added into this fund by the promoter on top of the subscriber's contribution. A RRIF, or a Registered Retirement Income Fund, is a fund that an individual transfers assets from another registered plan or fund, and the carrier will make regular payments to the beneficiary in annuity, basically until they die. A RRIF must be created before the beneficiary turns 71. Once an RRIF is created, it cannot be changed and is terminated upon the death of the beneficiary. The most relevant savings vehicles for athletes are TFSAs and RRSPs. What is the difference between a TFSA and a RRSP? With a TFSA, an individual contributes their after-tax income into a specific type of savings account. The benefits of a TFSA is that any income earned from the investment of the funds in the savings account is not taxable. A TFSA makes sense when you have little or no taxable income for the year, but still have some money left over and available to put towards your savings. With a RRSP, an individual contributes their pre-tax income into the specific account. The benefits of a RRSP is that with any contributions made, a corresponding deduction is made from your taxable income. Note that there is no reason to use any of your available RRSP contribution room if your income would not have been subject to income tax in the first place. TFSAs and RRSPs are available pretty much everywhere other financial instruments are offered. They are readily available from banks, financial advisors, and credit unions. How does a TFSA work? A TFSA is available to Canadians 18 and over so that they may set money aside throughout their lifetime and not be taxed on any interest income earned from their contributions. Contribution room is allocated at $5,000 per year since the account is created. Beginning in 2013, the contribution room will increase to $5,500 per year and will continue to be adjusted for inflation going forward. Any unused contribution room may be carried forward to the following year. This carry-forward mechanism is a function of one's remaining contribution room plus any withdrawals made from the previous year. See an example of how this works on the previous and current slide. What type of investments can you make with the TFSA? The qualified investments are determined by the Income Tax Act. There are a good number of different and flexible options available, as TFSAs have a similar set of rules that govern RRSPs. Some of the more common types of TFSA investments are cash, such as a simple savings account, shares, specific trust accounts, mutual funds, GICs, and bonds. You may have more than one TFSA, but it is your responsibility to make sure you do not make an overt contribution. Otherwise, you may be subject to penalties, which is currently 1% of the difference per month. How does a RRSP work? Contributing to a RRSP defers paying income taxes on a corresponding portion of income when deposits remain within the allowable contribution room. You do not have to pay income tax on funds invested in a RRSP until the funds are withdrawn. Any investment income received within a RRSP grows tax-free, again, until it is withdrawn. When an individual withdraws funds from their RRSP, every dollar is then included as income in the same taxation year that it is withdrawn from, and it is taxed accordingly. What can you use RRSP funds for? Generally, you are supposed to save your RRSP funds for retirement. However, there are other qualified investments you can make, but it is best to speak with a financial advisor before doing so. Your RRSP contribution room starts to grow once you turn 18 and file income taxes. The contribution room is based on your taxable income and will carry forward to following years regardless of whether you contribute to an RRSP or not. Two built-in exceptions to the general rules governing RRSPs are the Home Buyers Plan and the Lifelong Learning Plan. The Home Buyers Plan allows individuals to withdraw funds from their RRSP to use for a down payment on a first home without having such amounts included in the individual's taxable income for that year. The Lifelong Learning Plan functions the same way as the Home Buyers Plan. However, in this case, the funds may be used for expenses related to continuing education. The contribution deadline for the 2012 tax year was March 1, 2013. Any RRSP contributions made before that March 1, 2013 deadline is deductible from an individual's 2012 income. Like the TFSA, RRSPs have a carry-forward mechanism. Any contribution room not used by an individual in that taxation year moves forward and is added to that individual's contribution room in the following year. For more information regarding athlete-specific tax information, please see our next video.